Welcome. Thank you for watching today as we go through the Eastside Crossing apartment community located here in Atlanta. As we wrap up the second quarter, we have a couple things that we're going to be sending out. We're always trying to improve the quality and the clarity of the information we send around how the investments are performing. So this quarter, you'll receive your cover sheet that has our standard cover page with some commentary on it. You'll also receive a video update like this that goes through each asset and how we are maximizing your investment returns on it. And the third part is we'll have an information session on each asset class with a live Q&A to help address any questions you may have on kind of the overall market or where we're looking at in each asset class, whether that's residential or industrial or medical or net lease. We'll have a video session for each one of those. Now let's dive into the Eastside Crossing asset and see how we're doing. On the positive side, revenue growth at Eastside Crossing continues to be strong. We saw over 5% revenue growth in the second quarter. April alone was probably one of our best months we've ever had. We had strong revenue gains and we also had almost no expenses. This expense control right now is really coming from turnover. We saw the past 2 quarters, so we've had 6 months now of very strong retention. We're seeing 60 to 80% retention across the asset. And what that enables us to do is really be aggressive on the few units we do have that turn on those rental rates. Like I said, for the second quarter, we had 9 units that turned over, and we saw significant rental rate growth on those of over $100 a unit. The other thing that it enables us to do is with higher retention, we have lower operating expenses. Turnover is the largest expense that we have on the asset. And every time we have a period with high turnover, we have really high expenses, especially in the environment now where costs and supplies are very challenging. And that's really where we're seeing growth or inflation impacting our business, is that supply and cost structure of all materials related to turnover. So we have less turnovers, we have less need for those items, and that really helps keep our expense ratios lower. Another part that's a big positive right now is our debt. When we secure long-term debt on these assets, we have an average rate of 4.5% that goes out all the way until 2028. We did that with Fannie Mae, and we are paying principal on these loans, and we have about $12,000 per month of principal pay down that we are doing. So overall, we are seeing strong revenue growth and our expense controls are helping right now. So we have year-to-date revenue growth of $23,000 and year-to-date expense growth of only $3,000. As long as that trend is continuing in that direction, we are in good shape. On the challenges side, here at Eastside Crossing, it's really the area that the property is in. When we purchased it, there were single-family homes that were very dilapidated that you could buy for $50,000. Now, most homes are over $500,000. There has been a lot of improvement to the area, but there's still some definite rough patches. Due to that, the biggest change we saw was really our insurance rates. So we have 2 types of insurance here. We have our property, casualty, and liability insurance. I guess that's 3, but that pool of it. And then we also have flood insurance. The asset is located directly on Sugar Creek, and this is probably our 3rd or 4th deal that we have on that actual little creek, and we're within 100 feet of the creek, one of the buildings is. So we have flood insurance on that building for the lower floor. Both of these insurance pools went up about 10% year over year in 2022. Now we start seeing continued compounding of 10% each year. That becomes very expensive on the insurance side. The other challenge we had too was not only did the rates go up, but there were less carriers that were interested in entering the market. I think that stems from insurance uncertainty. Their underwriting wasn't certain on how these specific areas were due. We saw a much more demand for suburban locations versus urban locations when we did our insurance renewals. That really trickled through Q4 of 2021 and into Q1. So now we're at a point where we have much higher than expected insurance rates. And we foresee that continuing until something changes dramatically in the market. Now, to counter that, we do feel that we have a very safe property with lower turnover. All of our residents really know each other, and we believe that makes our community safer. We do not have a gate. That's something with the age of the building And when it was built, the egress points onto the main road do not allow us to put a gate up on the property. So that's one thing we're conscious of. So we are constantly around and at the asset to make sure that it does remain safe. We have not had any big insurance issues. We have not had anything reported. So we feel like we're in good shape, but it's something we're definitely keeping an eye on. Now, when we think about strategies that we're using to maximize the investment returns, I mentioned in the beginning that we're really looking at our income outpacing our expenses, especially in an inflationary environment with rates rising. We're very conscious that we're making sure we're doing the best we can at that. One thing we're looking at is our revenue capture model. In the past, we had always based our revenue gains on our retention. If we had high retention, we felt like we could have higher revenue or higher rental rates or higher renewals. That's really how we pushed the revenue side. And we had lower retention. It was more of a pump the brakes kind of scenario. We're like, wait a minute here. If we're having low retention, we don't want to have a lot of people moving out, driving up our expenses, so let's lower our rates. Now, over the past 2 years, 2020, 2021, we were able to see lower retention and higher rates, which is the opposite of what we saw over the past 7, 8 years in the market. And now what we're focused on doing is that when we have renewals that come up, we do want to maintain our retention rates, but we are taking those renewals from their current to the new market rates that are out there. So that's always the bump that we're getting there now. And then we have full units that turn over, where someone does not renew, and we have a fresh unit that we can now rent. We're trying to maximize the revenue gains that we can get on those new units and really push the envelope to say, hey, how high can we get these rates that are within reason for the market and within reason for the quality of the asset that we have. In doing so, we're able to then maximize our revenue. That we believe, although we're getting good revenue gains now, we do expect that our expenses will rise up, and that comes in both form of taxes and insurance. Those things we can't really get around. Those are not really controllable on our end, so we need to earn that money now to be in position to pay higher taxes and insurance going forward. But year to date, we are very much ahead. We're $23,000 above 2020-21 in revenue and only $3,000 ahead in expenses. So strategy going forwards, we like holding this asset. Our debt is in a good position, and we are going to focus on expanding our revenues to our expense growth, and that'll always keep us on a positive footing and able to make continued distributions. In the second quarter, we are making a full distribution. You'll see that hit your accounts on July 20th. Thank you very much for watching, and please check out our other updates for properties that you haven't invested in, and you can look at our market level overviews as well. Thank you.